Hello, everyone, and welcome to another edition of The Pitch, a new episode here on StockCharts TV. I am your host for today's show. My name is Grayson Roze. I'm the Vice President of Operations here at StockCharts.com, and it is a thrill to be back with you for another monthly episode of The Pitch. Today, I have three fantastic technicians with me. I am so excited to bring them on, share their thoughts on the market, share their picks, some of their latest finds for the current climate. Really excited to dig into the action with these three. So I'm going to introduce them in just a second. I'm going to give you a quick overview on how this show works. It's a pretty fun one, a pretty dynamic one. So let me give you the quick rundown. Here's how it's going to work. Each technician is going to have about 7 minutes on the clock to run through their 5 top ideas for the current market environment. Now, they're going to show you the charts. They're going to walk you through everything. We're going to talk about them. I'm going to have some questions for them at the end. And at the end of all 3 presentations, we're going to come back together as a group, going to pepper them with some additional questions for the group, get some discussion going, some conversation between the 3. It's just going to be a blast. This is one of my favorite shows that we do on StockCharts TV. So I'm really looking forward to seeing what these 3 have in store for us today. Now, the 3 guests that I'm bringing on with me today, I am so excited about. First and foremost, we have Mark Newton. Mark is the president and founder of ML Newton Advisors. Mark, how are you? Thanks for joining.
Very well. Thanks, Grayson. It's great to be here.
Yeah, looking forward to hearing from you. Next up, we have Erin Swenlin. Erin is the co-founder of DecisionPoint.com, a longtime face and figure here at StockCharts.com. Erin, it is so good to see your smiling face this morning. How are you?
Well, thank you so very much, Grayson. Great to be here.
Yeah, I can't wait to dive into your charts as well. And third up, we have John Kosar. John is the Chief Market Strategist at Asbury Research. John, it is so good to hear from you and see you. I'm so looking forward to diving into your charts, maybe even talking about a little Chicago pizza there, too.
Thank you.
Yeah. So anyways, first up, we have Mark Newton. I'm going to dive into the screen here. Mark, I've got your charts up on my screen, so I'm going to put 7 minutes on the clock. You've got time to take it away. We're going to dive into your 5 picks. What do you have for us?
Thanks, Grayson. So I wanted to take a look at 3 longs and 2 shorts that investors can consider in this environment. The first being Grayscale Bitcoin Trust. And so this is just a way for investors to be able to play the cryptocurrency space, and in particular Bitcoin. You see a weekly chart from StockCharts of Bitcoin's, of the Grayscale Trust, going back since really 2018. This is particularly attractive on an intermediate term basis for me. We have seen some recent ability of this to rise really to the highest level we've seen since the latter part of last year. So you see the trend line that was recently broken. We've seen a pattern recently of higher highs, higher lows, but the giant base really is what stands out to me, since Bitcoin, of course, made its peak back in late 2017 and has been in large consolidation since that time. So, I find bases like this really attractive, particularly at a time when cryptocurrencies are starting to gain institutional acceptance and technically momentum is starting to trend higher. We've seen some great volume recently as this has lifted in recent days. And so while near term, you might argue that it's getting a little bit overdone, really any sort of pullback should be a great time to participate. And seasonally speaking, Bitcoin started trading back in 2009, and really Q4 tends to be one of the better times to participate in cryptocurrencies. And so it's had a stellar track record. So I do think that this is a great choice for investors, particularly given these volatile times. So the next chart, if you want to take a look at Xcel Energy, utilities, of course, being one of the top performers of the last month at a time when technology has started to fall off. Xcel recently has started to show real evidence of technical improvement. We see what I view to be a large cup and handle pattern just going back since really March of this year. We peaked out in the latter part of February. We've been basing, in the last couple of months have been sideways. That literally has given way to a breakout of sorts that happened last month. What's appealing to me is that we recently have pulled back and consolidated some of these gains right back to the area near the breakout. So that makes it appealing to try to buy dips. And just the last couple of days, we perked up a little bit. So, I really like owning utilities in a time of market consolidation when we're seeing a little bit of a pullback to the broader market and utilities likely outperform. So this is really my second choice for being long and Xcel Energy. The third one we'll look at is just Lennar. Now, we all know how great the home building stocks have been this year. Recently, you've seen a little bit of a dip in lumber, to say the least, and so the home building crew has followed suit. We've seen 2 straight weeks of pullback. I view this area near $70, really between 70 and 72, to be really attractive towards buying that first dip in stocks like Lennar. So this has been a stellar name, and now we've pulled back to an area. You can see on the left-hand side of the chart, we peaked out the early part of 2018 in January, and recently we almost double tops back in February of this year, and now we saw the breakout this summer through this area of resistance. The golden rule in technical analysis on that first breakout, when it really pulls back to test the area of the breakout, that's normally an area you'd want to be buying into. So while I do have concerns about the extent of lumber's decline and the weekly momentum, short-term momentum is now growing oversold, and it's really the first chance after a pretty steep sell-off the last couple of weeks to really look to buy dips in stocks like Lennar. So I like buying at current levels and thinking we can have a decent bounce in the month of November, and we'll see the extent of how the bounce materializes, but for now, this is attractive for me to buy dips. The next one, we'll look at a couple different shorts. Live Nation is one recently that's gotten a lot worse, and of course, Live Nation bought Ticketmaster, and with COVID and the spread of the disease, we've seen there are hardly any sort of live concerts happening, if any, and this stock really struggled after having peaked out in June. We had a pretty sharp bounce off of lows, and since then it's really struggled. So it peaked in June, July, and then it really double tops back in the latter part of September, and since then it's really struggled. What's appealing to me for a short is the fact that this recently broke down under an area that's held really for the last 6 months. So for me, it's compelling to think that as COVID starts to spread, that it's going to be a lot more difficult for people to even consider going to live concerts. And technically, a break of a 6-month or longer trend line like this for me is really appealing. So I do feel that this starts to have a more meaningful sell-off over the next couple months. It's one I want to avoid and or short and look to really add on any sort of strength if we get any sort of bounce whatsoever in the month of November. The final name I want to talk about is EOG, and we all know that energy has been absolutely shellacked. It's been one of the worst groups of the year. Crude has actually been showing recent signs of trying to roll over in recent days and is entering a very seasonally bearish time. So for me, EOG is one that particularly one can still look to short and to avoid. I do expect to see a move down to really test the lows that were made this past spring. So that the ongoing channel, downtrend channel, has been ongoing since this past summer, and we've seen recent faltering. And I think the wave structure on it, the bounce we've seen, has been corrective in nature from an Elliott wave perspective. So now the stock seems to be starting to turn back lower. Oversold is not really an excuse as to why one would want to own any of these names. So for now, with my thinking that crude could roll over and pull back to the low 30s, high 20s, I still want to avoid energy. EOG would still be a pick within the E&P sector as one that can still show further weakness and should pull back to test recent lows. So this is an avoid and or short for me. So those are my 5.
Gotcha. Mark, these are such great charts, such great selections. I got to say, I love that you threw 2 shorts in there too, just to, get some other perspective. It's not always long in this market. And I think we're timing that well with the action that we're seeing today in the sell-off this morning. We're recording this here on Wednesday morning. So I love your picks. I do have one question for you. I actually want to go back to the Grayscale Bitcoin Trust. I think this is such an interesting pick. Obviously, the whole crypto space continues to evolve. I love that you talked about the institutional support that's been coming in. It's been interesting to see, a lot of companies start to support it as well, actually trying to hold things like Bitcoin on their balance sheets. Companies like Square, for example. I'd love to just kind of get your thoughts on that whole space. Are you primarily interested in Bitcoin? Are you looking at any other cryptocurrencies as well? How are you thinking about that space overall?
Yeah, I do own Bitcoin and Ethereum and a lot of the top capitalization type altcoins that are out there. So outside of Bitcoin, I would pick Ethereum, Chainlink, and those are at least the next two behind Bitcoin. But Bitcoin has shown a lot of relative strength. We've actually seen more strength in Bitcoin in recent weeks, which has actually been, it wasn't the case initially. A couple of years ago, a lot more of the other coins were showing more relative strength, and Bitcoin has really turned out to be the leader, given this institutional desire to really put cash to work in some of the cryptocurrencies as this trend moves towards digital currencies and away from cash. So, my thinking is this is a great something to own for diversification. Technically, it looks stellar to me. So, near term, I own it. If I were to trade it, I might trade some near 16 for GBTC, and then really look to buy any sort of pullbacks we get in the weeks ahead in the month of November, and think that this can continue to power higher into year end and potentially next year as well. So it's certainly a part of my portfolio and one I like owning.
That's great. That's a great answer. Great to hear. It's funny also to see anything related to the crypto space on a weekly chart, because I feel like so often we see so much short-term thinking in that space. So I love that you're looking at this on a weekly chart. Anyways, next up, we are going to dive into Erin's charts. Erin, I'm going to flip over to you. So excited to walk through your picks for today's show. What do you got for us?
All right. Well, definitely they looked a lot better last night when I sent them to you.
We timed that well, didn't we?
As my go-to, I have to say this offers us much better entries now.
Yeah, there you go. There you go.
I think that these are still strong stocks. I still like them at this point. So let's look at what I was looking at last night. So first off, communication services, internet stocks has been an area that we're seeing a lot of upside momentum. And so I was looking at my scans. I do decision point diamonds. And so I do a scan, various scans, and present 5 picks basically 3 times a week. And so when I went through my picks, 4 of these were what I presented last night to my subscribers. And like I said, 3 are internet. So the first one, actually, I think 2 are what I sent you, but the first one is Interactive Corp. And what I liked about this is we had the breakout from that declining trend. We have an RSI that is positive, and then I love seeing those PMO, either a whipsaw or a bottom above the signal line. Plus, we now have the PMO in above 0. The PMO is the price momentum oscillator. This is a decision point exclusive indicator. And we love it. It works very similarly to the PPO, but we developed it, and so we like it better. So anyway, it's now above the 0 line. You can see the OBV volume has been rising when you look in that thumbnail. So I like the setup here. So that was my first one. And my second one is Laboratory Corporation of America. This is a healthcare provider, and you can see it's been on a very nice rising trend. What I really like to see was that it broke out above both that July top, but of course, the February top as well. We still have an RSI that is very positive, but not overbought, which is something that I like. You have the PMO, which again, it had ticked lower, but then it has turned back up, and it is not overbought. So we know that we could see more momentum to the upside here. And of course, looking at that on-balance volume, really nice confirmation as all of those bottoms on the OBV are rising. And then, of course, I love the StockCharts technical ranks, so you'll see those on all of my charts. And the scooter had just moved into what I call the hot zone, which is 75 or above, because that tells you that that stock is in the top quartile, of all of the stocks within its universe, being, in this case, the large caps. So I liked LH. Let's see, next up will be Repligen. Now this one, I have it marked. I had this as a decision point diamond back in July. And since then, obviously, it's done very well. And, I like the breakout. I think this one was still going to go higher. My only concern last night was that the RSI is a little bit on the overbought side. But a lot of times what I'll do is I'll look back in time and see what happened when the RSI was very overbought. And then I just check what kind of a decline you saw off of that. And so these declines have been heavy, but they haven't been terrible when it gets overbought. And so at this point, I like it, even though it's a bit overbought. Today, I have to say it is lower, so we're going to see the RSI be lower as well, obviously. But you can see that StockCharts technical rank has been in that hot zone for a very long time. So I know that the strong has internal strength as well as relative strength based on just the scooter. And then, of course, you can see that the PMO is still rising. It's decelerated somewhat, but that's okay. We don't want it to get too overbought. So I liked Repligen. That's a good one for me. And then I have two more. One is Sonos, and this is in the electronic equipment industry group. I love Sonos. I own Sonos in my home. I don't actually own it in my portfolio, but I think it's a great company. Really nice PMO that just started to accelerate upward. RSI is positive and not overbought. And again, you have that OBV confirmation as those bottoms continue to rise. And of course, again, that scooter in the hot zone. So I like this one. I think Sonos should do fairly well. And the next one and last one is Spotify. And this is another internet stock. I guess I was into the music because I have my Sonos and then I have Spotify that I usually play on it. But it actually turned out that these came up in my scans yesterday together, not just because I like to listen to Spotify on my Sonos. But we have a really nice PMO buy signal that came in oversold territory. It's still rising. It's now positive and above zero. The only issue I had, again, was we were looking pretty overbought here on that RSI. But that is not the case today, as it's pulled back quite a bit. But you can see the rising trend. It was just getting above that. We are looking at some pretty serious overhead resistance at 300. But like I said, that PMO is what convinced me. I really like the rise on it. It's gentle. It's not overbought. So this one I very much like for that reason. And of course, again, the StockCharts technical rank has been stellar since March. So you got to like that. So those were my 5 charts.
These are great selections. I got to say, you picked 2 hot S stocks that are both quite the pair, Spotify and Sonos working together there. But I love those picks. I love the charts as well. Erin, one thing that stands out to me about your charts, I love your charts, by the way. They're just beautiful charts, and the indicators that you use and everything are just fantastic. One thing that stands out to me is your use of EMAs sort of across the board. You've got the 5, the 20, the 50, and the 200-day EMAs on your charts. Talk to us a little bit about the choice between EMAs and SMAs. A lot of people, kind of gravitate towards EMAs for the shorter term and SMAs for the longer term. But talk to us about your use of EMAs sort of across the board. I find that really interesting.
Certainly. So with EMAs, it puts more emphasis on near-term data, which is why you do see a lot of people using those shorter-term EMAs. We use EMAs all the way through. For the same reason, we want more emphasis on the near-term data, even with the 200-day EMA. And in fact, I think it even works better because I really want to see, what's going on more in the near term versus the, looking at the average, because you have that drop-off problem. When you have a big day and then that drops off, it changes your simple moving average by a lot. And then also at Decision Point, we do our trend models, which give us our mechanical signals, and we base those off of those crossovers. So a 5 and 20-day EMA crossover gives you a short-term trend model signal. 20/50, we call that a silver cross when the 20 crosses above the 50, and then of course 50 and 200, you've got your golden cross and your death cross, if you will. So yes, very much like that. And then I forgot to say, all of those little pink percentages on the right are stop levels. So whenever I do my diamonds,
Gotcha.
I always put a stop level, and then I show a weekly chart and put an upside target. So that's why you're seeing those. And it makes me feel better to present a chart and actually say, look, I wouldn't own it when it hits this point, or maybe that's a point you want to look for as an inflection point. Maybe you're going to get a bounce from that area and then make it more interesting. So
Absolutely. No, that's powerful. And I got to say also, I love your use of the Zoom thumbnail. You're emphasizing it there in your conversation, saying, you can see it more clearly in the Zoom thumbnail. For those of you who don't know, that's actually a feature of Sharp Charts that you can just turn on there on the workbench, but it gives you this sort of side panel with a sort of a near-term look, almost a zoomed-in look, hence the name, Zoom thumbnail. And that was a decision point creation, a really powerful addition to StockCharts. I've always loved that and love seeing you use it, Erin. So thank you for your picks. I'm excited to, I got more questions for you, but we're going to move on to John. And John, I am so thrilled to have you on the show today. Looking forward to your selections. What do you got for us?
Well, the first one I wanted to start with is XBI. It's the biotech ETF. And the reason I think it's important is because it tends to lead the market. It's got a 10-year positive linear correlation with the S&P 500 that's been tight and stable through that whole period. And you can see we broke out on October the 7th after being sideways for about 6 weeks. So that suggests that the market thought the March 18 move higher was starting to re-engage there. It got up, tried to get back over the July 21 high, failed, and now we're sitting right at that inflection point where the lines converge. That's at 113.84. And very interestingly, we have been bouncing off of that either for the past 3 or 4 days. So the market sees it. That means if the market is good, or if this particular ETF is good, if the biotech sector is good, it needs to re-engage from right here at 113.84. If it does not, and we roll through there and we start having a couple of closes through there, that means the market's changed its mind. And that would suggest to me that we're probably going to go back and retest that September 4th low, which is right around 102. It's actually 101.82. So I'm looking, what I try to do is when the markets are moving, I try to find key charts where I can pinpoint where you could either put some leverage on and take advantage of something, or if it goes against you, it's only by a small amount. So I look at everything in terms of risk reward. This suggests to me if we can't hold here, it's not only bad for biotech sector, but it's also bad for the market because of the correlation. Now we've got Amazon. Amazon is another one. Obviously, it's a giant stock in terms of market cap. And it's also been an indecision since the September 2nd high. Whenever you see those coils, I really like them because you can really quantify your risk reward there. And you can see when a move is beginning. So I haven't looked at it in about 30 minutes and everything's moving pretty fast today, but we're right around that 3180 level, which is the lower part of that investor indecision. If we should break down through there, that's going to take us down to 2550. That would be the measurement from there based on the width of the pattern. So that's another one I'm watching, and that's got a 20-year positive correlation with the S&P 500 as well. So we don't have that sort of pattern in the major indexes, but we do have it in a lot of the stocks that move just like the S&P 500. Our next one is Abbott Labs. This one is interesting to me because, again, you're seeing that sideways theme. But Abbott Labs was trying to develop a test, a fast test for COVID. And actually, the FDA bent the rules a little bit, as I understand it, to allow them to have a little bit more latitude in terms of putting something on the market faster. So I'm looking at this as almost a surrogate for how quickly the market thinks we're going to have faster testing and just better mechanics, for testing people in terms of COVID. If we break through 116.05, you can see we're sitting right on top of it. That takes us down to 94, which is effectively a test of the 200-day moving average. And that's pretty far down. That's 11% underneath where we are right now. So I'm looking at this also a positive correlation to the S&P 500 over 40 years, but also an indication of what the market is thinking of COVID, situation with COVID. And then we have Coca-Cola here, KO, and again, another sideways type of a move, and this also has been moving up and down with the S&P 500 on a statistical basis for the past 40 years. We actually broke down on October 26th, which was 2 days ago. And you could see we're underneath the 200-day moving average now, and that whole sideways pattern was Coke was struggling to get above the 200-day moving average. Got above it, it fell back through it into the September lows. It took another shot at it and failed in mid-October, and we finally broke down. That target's 46. So I'm looking at this as another indication where the market is, it looks like it's giving up on some of these kind of bellwether stocks. And then finally, we have Borg Warner here. And again, this is another one. This has no correlation to the major indexes, consumer discretionary stock, but note the breakdown. After that, the theme here is the market's been trying to get its mojo back since it peaked in the early to middle part of September. It hasn't really been able to do that. This is another stock that just had a breakdown a couple of days ago, and it targets another 11% move down to 32.25, which would, of course, take it through its 200-day moving average. So if all these patterns start to reach the targets, we're starting to break 200-day moving averages, and this could be a precursor to a major trend change in the overall U.S. stock market.
Gotcha. John, these are great charts. I got to say, one of the things that I always love about your work is the simplicity of your charts. I mean, here we're looking at OHLC bars with the 200-day moving average. There's not a ton to it, and that is the strength of your charts. I always love to see that. And then the way that you're thinking about patterns and movements against the key moving averages like that, it's just fantastic. I love the simplicity of your view. One thing that I'm curious to ask you about is XBI. I love that you're talking about XBI as kind of a bellwether group. I'm curious to know, I hear this from a lot of people who say, the individual components within something like biotech are just a little too risky for me. So I'm going to play the group as a whole. Is that something that you think about, kind of playing the broader group in more of a volatile space like that, going for biotech as a whole as opposed to individual components? Or would you try to look for some individual positions within that space?
I think especially in this environment now, we're a week from the election, the S&P is down 100 today. Mm-hmm. Today's a special circumstance for those reasons, but I think generally because it tends to be a more volatile space, I think for most investors, buying the index rather than trying to pick any one particular one is just going to kind of dampen the movement, and you're still going to get the essence of what you want from the space without sticking your neck out there and maybe having the right idea on the space and picking the wrong stock. So yeah, I think that's for something like this, I think that's how I would certainly do it. But my interest here now is I'm trying to figure out the next move in the broad market. Yeah. Since this seems to lead, this is why I'm watching it so close.
Yeah. I think that's a great segue into another question, kind of talking about those, kind of bellwether groups. Are there other groups that you're looking at? I mean, a lot of people, for example, look at semiconductors as kind of a bellwether group for the market. I'd love to kind of open that up to the floor, bring Erin and Mark back in and say, what kind of individual groups sort of similar to biotech do you maybe look at as an indicator of where the market's going to go?
Yeah, I can answer that if you like.
Sure.
I mean, I look at semiconductors and transportation, obviously, as being two leading sectors. Those tend to be very interesting and almost always tend to precede movements in the broader market, at least from my perspective. So I think both of those are very important. Yeah.
For me, it's just, general the sector rotation. I mean, I think you're right. Semiconductors, really a technology as a whole, can give you the what's going to happen or is going on in the market, simply because you have these large cap companies like an Amazon and an Apple that really, take the market with them a lot of the time. So for me, I look at those bellwether stocks, of course, as, the FANG Plus, but, covering mainly the rotation is really what gives me that, sense of where the market is going to go, because those industry groups, they will change.
Sure.
Just depending on what's going on.
Sure.
Yeah, that's a great point from Erin. I mean, look at the defensive rotation in the last couple months. I mean, this actually preceded any of the weakness we've seen in the indices, and that's almost always something to really key in on. We saw it in January, February of this year, and now we saw it, recently, just in the last couple weeks. I mean, there's been indecision for months in terms of the election, about the virus, about the Fed and everything else, but only recently has defensive outperformance started to really take the forefront, and that really just preceded markets starting to show volatility.
Right. No, I mean, we're clearly seeing an outperformance of things like utilities, especially relative to technology. I think that's been a really interesting story, seeing tech really heavily underperforming utilities specifically. That kind of leads me to another question that I had for you that I found interesting. There was only one technology group or technology pick represented in the 15 selections that we made today. I'm curious to hear your thoughts on tech. Is that story kind of over? Do you think we're going to see more of this continued rotation to defensive sectors, or how are you kind of thinking about the tech space specifically? That's obviously been a big story this year.
One of the models that we have in-house here at Asbury Research, rather than looking at the relative performance of the prices of the sectors of the S&P 500, I actually follow the asset flows in all the spiders, and all the 11 spiders.
Interesting.
And I measure them relative to each other as to where the money is going in the space, in the sector space, and where it's coming from. And technology was getting all the attention from March through maybe 2 months ago. And then I saw there was money moving out of tech and moving into industrials. And in the middle of the summer, if you would have said industrials, you would say we're in the middle of a pandemic. Why would you want to buy industrials? Because the money was going there.
Yeah.
Where I'm seeing that money move now, and you mentioned that is really interesting to me, is just for the past month, there's a lot of money that is moving into the utility space. And it just came out of nowhere. It was sitting in the background. I didn't pay any attention to it all year, but now the utility space is quietly starting to attract a larger percentage of assets than the others. You're still getting some money going into industrials, but I think the dark horse that's kind of coming around the bend here is utility space, and I think it's worth watching between now and the end of the year.
Interesting.
If I could add just one point. I mean, you've seen the huge overconcentration of all these large cap growth stocks within technology and communication really dominate the indices and the ETFs. And I think that is a very big concern. If you saw also back in 2007 and 2000. So you've seen that rolling over not only in the large cap tech of late, but also on an equal-weighted basis that started actually back this summer. One of the things I look at is the RYT, which is the equal-weighted Invesco ETF for technology, and look at that relative to just the equal-weighted S&P. So you really strip out those large cap influences, and you have seen a real weakening. And in this environment, it makes sense. It's a very political year, but technology now is being attacked from both the left and the right. So you see a lot of these antitrust concerns is also a really big deal for technology that could be with us for a while to come. So yeah, I don't like technology. I would avoid it over the next 12 to 24 months.
Interesting. Erin, what are your thoughts?
Technology, one of the interesting things about technology, certainly coming out of the bear market low, was that, they do lead aggressively. It's an aggressive sector. But one of the things we found is that it also turned into somewhat of a defensive sector. You have the cloud computing, you have some of those areas, semiconductors, that have done very well. But I have to agree with Mark. What I see in the market in general is a giant intermediate term double top. And who leads the market which way or the other? Technology. And technology has gotten very overbought yet again. And, that's a place where you're going to see leadership, unfortunately, on the downside, too. So the utilities has been great. Absolutely love industrials. And like I said, the communication services area, I think there's some really strong industry groups there.
Yeah, absolutely. No, I mean, I've got our 15 picks here, and you can see the sectors that you guys have chosen. Obviously, we can see the one technology pick, the one utilities pick. It's interesting too that industrials are not represented in this group. I mean, John, I love that you brought up industrials and kind of the sneaky strength that we've seen out of that sector. Did you guys consider anything in that space? Are you finding any strength, or is it kind of like we talked about with XBI, maybe more about the group as a whole?
Well, for me, I do scans every day, to see with my scanning. And so what I like to do there is I see which, I do like you did right here. I look at what sectors and industry groups I'm seeing. Mm-hmm. Industrials continue to show a lot of strength. There are a lot of industrials in my scan results. Comm services, like I said, were also in the scan results. So as long as those are still showing that momentum, but when I do diamond picks, I'm looking overall at a chart. So sometimes I will end up with, for example, I've got a technology stock in there, but it does. I get all of those results. I look at them all on that candle glance, and I figure out which ones look stronger. But I have to say, industrials have really had and materials. Materials have been showing up in my scans quite a bit as well. Yeah.
Both, climbing up the scooter rankings. One thing that a lot of us here at StockCharts love to look at is the scooter ranking for the sectors. And when we see, what's leading the S&P 500, we see industrials, materials, utilities climbing up kind of to the top of those rankings, which is interesting. So, one other question that comes to mind for you guys. Obviously, Mark, you were talking about the election, some of the uncertainty that's around this time. The other big thing that we're facing right now, we're talking about individual picks. Obviously, we're in the middle of a heavy earnings season. I'm curious to hear from each of you how that impacts your movement right now. Are you looking at earnings dates and saying I'm gonna wait, or are you saying I'm still gonna dive in and I'm gonna kind of put the earnings reports aside? How does that shape your approach to any of these individual positions?
What I generally do is we have a couple of scans that we do, quantitative scans that look for either stocks that are breaking out of a sideways congestion area, like some of the charts that I showed today, or a stock that's had a good move down, a 10 or 15% move off the top, and it's still in a structural uptrend. And then we start looking at some of the internals getting better. Once we see those, I usually don't like to fool around with anything within a couple of weeks of earnings.
Okay.
Only because sometimes by the time your idea gets a chance to get some legs, earnings comes, and earnings a toss-up. It can go in your face for 3 to 5%, or you can go for you. And I like to take as much risk, unexpected risk out of the market as I can. So that's just my own thing. I usually see, I could love an idea, but if I'm right in front of earnings, I'll usually wait and try to get on it after earnings go by.
Gotcha.
Yeah, I would have to echo John's point. I think a lot of it depends on your risk tolerance. Earnings can always be tricky. It's a 50-50, so a lot of it depends on your time frame of investing and your risk tolerance and how you size the position. If you have a strong technical conviction in anything, then I think typically it's right to stick with that and really not consider earnings as much. But, as a 100% technician myself, technically oriented person in terms of how I look at the world, I don't necessarily consider earnings, but obviously, if I can wait until after earnings and things still line up, then it gives me a little bit stronger conviction, particularly if the fundamental backdrop is great, then that gives me that much more, conviction in my idea that I can stick with it technically. But I prefer not to put on big positions ahead of earnings.
I like that. Erin, you're kind of nodding there.
I very much agree. I always put the earnings dates and when I present my stocks in my diamonds reports. I don't say, hey, earnings, don't buy, or anything. That's really a choice by each investor. Personally, on a short-term trade, not interested. I don't want to, make myself open to a possible price shock, because we've seen that. You get great earnings and you get a price shock to the downside, and you weren't prepared, even if the chart looks very technically strong. However, if I have an intermediate or long-term position, it's intermediate or long-term, I'm going to hold through earnings.
Yeah.
And then, of course, if you do have a stock that performs well off of earnings, certainly a stock technically that you want to look at and consider, because strong earnings generally mean follow-on movement to the upside.
Right. Well, kind of related to that, I think that a lot of our viewers out there are probably wondering how you guys are approaching the markets around such another major event being the presidential election and everything coming up next week. So, again, how does that shape your approach right now? Any new trades you're putting on, any new positions you're taking on? How are you thinking about those relative to, the big event that we got coming up next Tuesday?
That's funny because I get that question all the time, and I'm sure you do too from your clients.
Yeah.
Is, what do you think is going to happen in the election?
Sure.
Who do you think is going to win, or when do you think the vaccine is going to come out? Or, and the point is, nobody knows that.
Yeah.
And even if you knew the answer, you don't know how the market's going to react.
Right.
Sometimes the president that is supposed to drive the market into the ground, 3 days later, it doesn't about face, and then it takes off straight higher for the next month. So I just try to follow the data. I'm not trying to pick the tops or the bottoms. I'm trying to get the middle 70%. I'm trying to find a wave of data. I do a lot of work with asset flows because that's one of the only things I've ever seen that actually precedes price. It's the push that gives the price, the direction you're looking for. So I don't, maybe right before the election, I may think twice about putting out an individual stock idea. But I would never try to use what I think the election's going to bring or something I read about COVID.
Sure.
That would never enter my mind.
So you're staying focused on the charts and you're trading what's in front of you.
I think that's the only way to keep swinging the club the same way.
Yeah.
Is to follow the data.
Yeah. Erin, Mark, what do you guys think?
Yeah, I agree exactly with what you're saying. The market doesn't particularly like uncertainty. And let's face it, every time we have a big move to one side or another, they always have a great news story as to why it's happened.
Sure.
I would say the uncertainty is just about the same as it always is in the market. You have to look at your technical indicators. I'm like you, Mark, I'm more of a technical analysis purist. So for me, I feel like everything's mostly baked into a chart. And so, yes, we've got this big event coming, but we also have COVID. We have so many other things going on that are uncertain. So, John, you're right. I mean, the uncertainty, the market doesn't like it. And I know that I will still be giving stock picks on election day and after, just based on the chart technically.
Yeah.
I would only add that, it's really, really important to tune out any sort of media or news or non-price driven factor into your approach. I think, trying to guess the election is really a coin flip at this point. The only reason I would look at the election is how sentiment is changing into the election, not really who's going to take control. We knew from the beginning of this year it was going to be likely contested and it might be difficult. My perception is that in the last couple of weeks, people have become more comfortable with the idea that a Biden win potentially wouldn't be as bad for the market, which is sort of interesting because a lot of the leading Wall Street shops had written previously that it was going to be a bigger deal. And so you see this complacency over the last week that directly preceded the recent volatility we're seeing. So, my cycle composite turned negative in September and shows specifically that we could be in for a year much more like 2018, 2 years ago, than last year. So we could be heading into a period where the seasonality directly does not support the idea of rising stock prices throughout the balance of the year. So for me, that means the election likely is going to be contested. It's right to be defensive, be diversified, and really not be making any sort of big bets. So regardless of one's thinking, but you should never really look at politics as being a driver, I think, of an investment process. And if we learned anything from 2016, everybody was convinced that the election of Trump was going to be a disaster for the market, and it wasn't. And so regardless of your political affiliation, you really have to look at the reasons of how you view the market. Heading into this year, we knew that earnings were going to be falling off after February, March. no guidance to speak of. The economy was slow to rebound. So all these things which investors look at as this is what drives stocks.
Right.
There was nothing to see except for follow the technicals, which were down into March. And then we've had a decent rebound. And now we're showing signs of that waning yet again. So it's important to follow technical analysis, obviously, look at sentiment, look at seasonality.
Sure.
But for all means and purposes, please, tune out politics and try not to let that enter your decision as to how you look at the world, at least in the short term.
Yeah, I love what you all are saying. It's sort of consistent, echoing across here with the whole group that the technicals matter. It's sort of a price first approach, and I love to see that. I mean, as we kind of wrap up, we're down short on time here at the end of the show. But as we wrap up, I'd love to actually lean into that a little bit. What I've got up on here on the screen is a daily chart of the S&P 500. I'm going to actually zoom in though a little bit more of a narrow view. This is a 3-month, 60-minute chart, so we can kind of see how the S&P 500 has been bouncing around here over the last few weeks. So, I think I'd love to get an answer from each of you. As we can kind of see here, we've been bouncing around really between about 3,500 and 3,200 on the S&P 500, sort of moving sideways in this consolidation range. As you think about kind of where we're going by the year end, do you think we're going to be above this range, above 3,550, below this range, below 3,200, or are we going to continue to bounce around sort of sideways in this range for a little while longer? What do each of you think we're going to do here on the S&P 500 by year end?
I'll lead off, I guess, if that's okay. I think we're going to be lower. We have a couple of in-house tactical models, and they both went to risk off as of the close yesterday. I've been watching the S&P like a hawk. You see my eyes drifting up to look at the screens up above. It looks like we're going to take a run at the 200-day moving average, which is around 3,100.
Yep.
From there, I think that's when reaction to the election is going to be a factor. Again, I'm not going to put a trade on because of who won, but I'll be watching the data after the election. There's some talk about a vaccine coming. I've got a couple of friends that are doctors, and we chat about that all the time. But I do think what's happening here is meaningful, especially if you see, biotech start to roll over. That was the first chart that I showed. I think we at least see the 200-day moving average and maybe lower than that.
Gotcha. Erin and Mark, what do you guys think?
I think it'll be lower. I really hope it isn't. But, when I look at my weekly charts and I look at my weekly PMO, turned down, they're overbought. We've got that giant double top. I think most of us technicians have been watching and can see on the SPY and the S&P 500. Time will tell, obviously, but I don't want to leave that with, well, we'll see. But my sense is that we are going to hit that 320, 3,200 level. And that's really your confirmation line, right, for that double top.
Sure.
And sadly, I don't think we're going to hold that support level. I'd like to see us just move sideways into the end of the year, but I suspect that's not going to be the case.
Mark?
Well, I hate to agree with consensus, but I have to. I think the market is going to be lower into year end. We could stall out, at least temporarily, near September lows, potentially into election time. But really, any bounce into mid-November, late November, should be used as a chance to sell into, thinking that between mid-November and mid-December could actually be down pretty sharply. So I think we'll take out 3,200 and get down potentially down to 2,900, 2,800. Before we see much support. And so, there are a few things that stand out. One is the increase in defensive trading, which we mentioned. One is technology really starting to roll over, and is the S&P's largest sector. That's a concern.
Yep.
My cycle composite turns lower, and I think that, there's still a lot of uncertainty. And, bottom line is that trends have been positive, but you're starting to see a lot of these equal-weighted indices really have not been moving to all-time high territory. So largely it's been just the cap-weighted, but when you look at equal-weighted terms, technology has been carrying the load for the entire market. And if that starts to wane, as we've seen, can these other sectors, step in and pick up the slack? I just don't know that they can. I think that financials have been aided a bit, but those are going to start to wane. And so, I have to lean bearish into year end. So I'll look at buying dips if I get the chance, in December, and hope to start the year off on a better note. But yeah, my models, are pretty negative.
Sure. Well, we are 3 for 3 heading lower with this group, but I think we do have some fantastic individual picks. I loved the stocks, the funds that you guys chose, long and short. We had quite the difference in perspectives today that was just fantastic to see. So, I want to thank you all so much for joining us. It is so fun to do a show like this with 3 seasoned strategists like you three. It is just fantastic. So, John, I want to thank you so much. John Kosar from Asbury Research, Erin Swenlin from Decision Point, thank you for being here, and Mark Newton from ML Advisors. Thank you so much for being here. Everyone, you can find these charts. We're going to put them up actually at the pitch, stockcharts.com/pitch charts. You can find all these charts. We're going to put them up there. So exciting stuff for you. You can actually download them into your own account. Again, I want to thank our guests for being here. I want to thank all you viewers for joining us today in quite an interesting time for the markets, quite an interesting week, and we've got quite an interesting couple of weeks ahead of us here, I'm sure. So again, thank you everyone for joining us. Thank you for tuning in, and we will see you next month for another edition of The Pitch on StockCharts TV.
Hey, Grayson Roze here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.